Is China's economy heading for economic collapse, and what does it mean for us around the world? Hello, ladies and gentlemen, and welcome back. Today we discuss the Evergrande saga. They've filed for bankruptcy, but it doesn't just stop there. We've got shadow banks in China and other big developers starting to fall, and it looks like everyone's missing payments. What happens next? Today we'll discuss it. We also need to talk about Bitcoin again. Elon Musk's SpaceX has just sent Bitcoin tumbling after selling all of their holdings. But there are also other problems for the US market, and it has to do with long-term yields. 10, 20, and 30-year yields are spiking back up, and that's causing Tesla, crypto, and of course, the S&P 500 to have 3 days of pretty big selling. Let's get into it. Well, welcome back everybody to the Daily Show where we talk about markets around the world. If you like macro, leading indicators, and of course the hottest charts, we've got all of those along with stocks, commodities, and cryptos coming up today. Make sure to subscribe if you like everything to do with markets. So what happened over the last 24 hours? Well, we saw some of the weak style technical analysis stocks falling pretty drastically. We also saw some large selling come in from Meta, restaurants, and everything to do with economic pain. We also need to discuss something else, which of course comes back to China. Here are the latest stats for new home prices or prices in houses in general. They were down a whopping 3% over the last month. And of course, this is the worst we've ever recorded for a very long time. Of course, this data going back to 2011. So what does China need to do? Well, we know that they tend to always have a meeting that happens in October. And we also know that seasonally adjusted, this is usually a weak period of time. But is there going to be a stim pack coming? It looks like they're going to have to do it because rate cuts are doing nothing to that economy right now. But what happens with the stocks and what happens with property may be very different, and we'll discuss that later on today. We also need to talk about this big story. Treasury yields, they keep rising and they're causing pain for stock market investors. It looks like 10, 20, and 30 year are all going up. And this is in line with, of course, what we've talked about recently, which is a dip after such a huge move. Once we move underneath 70 on the BEP SPX, which is bullish percent index, we tend to see a relatively good pullback. But how much worse does it get? Well, let's go through what insiders are doing first. We know, according to Bank of America, that institutions and hedge funds have been selling very heavily over the last couple of weeks. But we also know that even though they're selling, August, September, and October are traditionally the weakest months for the US. Basically, we see what we call a double dipping effect. If you're a bull and you like stats, then you've still got to like how the market looks by the end of this year. You also need to think about sentiment as well. We're slowly seeing it tip. We've got a new big report coming in here, and it shows us that bears went back up to 30%. If that leads into 35 or even 40, we probably are very close to the lows in markets. And of course, the bullish percent index was well over 50% plus as of the 19th of July, which just so happened to be the top of the NASDAQ. It's funny how we all FOMO in, and then right on that right thing, they rug pull from us. So we're following the same track as we always do. At this stage, yes, of course, news is now flooding out that's bad pretty much everywhere, and we know that we're facing this point. If we're going to bottom in markets, traditionally we do it around the end of August, but there are trillions of dollars at stake this Friday. So where do we think the market could stop? We'll also look at that as we look at the charts together. So as I mentioned, JP Morgan and other banks are starting to come through with some interesting information about what we're doing as retail traders and what big institutions are doing. So this is a note I posted on it over at our X account or Twitter account. Follow us in the links in the description down below. And it basically says here that JP Morgan over the previous week observed a notable disparity in selling activity across both cash and futures markets. In the realm of cash equities, institutional investors displayed a net selling of $13.3 billion throughout the trading hours, along with $11 billion during the market on close. Now, notice the size of the market on close. I always say the close is the key. That should be the proof that huge amounts of transactions go through that period of time. Concurrently with the futures market, institutional investors demonstrated a net selling of $8.1 billion, primarily driven by significant selling pressure throughout, of course, the S&P 500 contract. So it just shows you that institutions are pushing this down. So speaking of unusual activity and of course what JP Morgan have been telling us, let's have a look at the big transactions of the last 24 hours. And more notably, they were in the SPY, or the S&P 500. We saw clusters of trades going through that were fairly large near the close. We also saw a big dark pool on a 2x fund, SSO, so basically a leverage fund, which tends to be used by these larger traders for very quick moves, happening right down the bottom. So again, at the close. What does this mean for us as traders? Well, we can go over and have a look at the unusual options activity as well, but we also want to watch some of the price action happening on Friday. It could tell us a lot about whether we're going to continue to sell next week or not. Let's move over to this options activity, and we saw some big activity across a couple of smaller pairs. We also saw things like PayPal starting to come back in with some options, 1.14 times average, 4.82 for Triple M, and basically it was just a lot of trades through the S&P 500 for the first time in a while. We got a 1.3 times 90-day average, and of course we saw Qs sitting very high as well. You know what's more interesting though? We still continue to see a huge amount of call buying. 50% calls, 50% puts. Oftentimes, once we had volume like this and we were falling, if you go back as little as 3 or 4 months ago, you would have seen about 65% puts at this point. It does still open us up to showing that retail traders and the general market, mostly probably retail traders based on what JP Morgan was telling us, are buying the dip heavily with short-dated and probably medium-dated calls. And that allows the market to potentially go a little bit lower here moving forward. Let's move through rotation. What happened? We saw energy doing okay over the last 24 hours. It had some rebalancing up with XLE loading 1.2%, and every single thing pretty much to do with growth was down, but also defensives were down. Healthcare, staples, even utilities, they were all barely holding up above. Now let's move over to the 5 days, and it's pretty much the same story. We've got mostly inflation-based trades such as metals and energy. I think a lot of those are also stim-based trades for China in the future. And then we've got healthcare, utilities, and again, most of the staples up the top. Solar, clean energy, regional banks, and even gold are certainly not liking these high yields at this stage. So how much longer until we find the bottom, you might ask? Well, traditionally we use certain things to try to figure out whether we're a little bit oversold or not. The 20 moving average certainly has hit that zone, but not the 50. So we usually look for percentage of stocks above the 50-day moving average to move quite a lot lower. And this is one of the reasons that shows you that a market maybe is overextended. We're not quite there yet. We're trading at about a 36, and we're looking for it to go underneath 30. And you'll notice it's marking quite a lot of previous highs and lows using something like this. But what about yields? US 2-year still remains one of the yields we want to be looking at, but most people are on the long date yields. US 10, US 20. Take a look at the US 20 and 30Y. We'll put the 30Y up here and check out what it's doing. New highs being broken this week. And if we do close like this, we're in the unknown. And you know what markets hate more than anything else? The fear of the unknown. This is always the problem with markets. They tend to like it. They tend to be okay when you're trading with range. Even if the news is bad, they've repriced to become efficient. But when they break out, if things get scary and this starts flying up, you've got to be concerned about buying the dip at this stage. Maybe we're looking for that to kind of recover a little bit. The volatility of the volatility, the VIX might be suppressed, but we can see that volatility is still spiking underneath, and that's continued on up throughout the last 24 hours. So let's take a look at another problem around the world. It's not just China that's having issues. And by the way, China has really a three-pronged issue right now. They've got slowdowns, deglobalization, and of course they've got a massive demographic problem as well. And that's going to be the story, I would say, for the next 10 to 15 years. How do you take a population that's aging and then somehow plug the hole of not having a young enough population to come through and support them? It is going to be a massive issue. And I'd say that is the biggest problem with China moving forward. But that doesn't mean that they'll let it break and fall right now. I think there's a stimulus pack that's just around the corner that they'll be working on pretty closely. It will require a massive amount, though. It's not going to be easy to turn this real estate market. Let's talk about JP10Y though. Bank of Japan, of course, has been active in this market, unraveling everything they've been doing for years and saying, hey, we'll allow it to go up to 1%. If this starts to spike, make sure you set your alerts for it, because if it gets past 0.7, 0.8, 0.9, it's sure to do things to US 10-year, 20 and 30-year yields. It's going to hurt treasuries. It's going to do a whole bunch of things. So just remember that could be coming. Let's move over to copper. What's it doing? It found some support along with metals over the last 24 hours, and it hasn't closed underneath this low. So we'll be watching copper very closely, update you on the weekend for that one, so make sure to stick around. What about treasuries? Well, they're falling and they're not doing very well at all. You can see here on the weekly, it's right back down. I suspect the treasuries with the breakouts, especially in the US 10-year, 20 and 30-year, could be moving towards this 88.90 zone. And if it does happen, that will be a very interesting level. Everyone will hate treasuries at that point, and that's usually when you start loving them, especially when you're in that kind of territory that we haven't seen for basically over a decade. I mean, look at this. Look how far back it is here. 2008, 9, 10, and 11 was the last time we hit those levels. Let's talk about a consumer discretionary versus staples. The thing that's unique about this sell-off is it's not very defensive. It's kind of like all sectors across the board, but consumer discretionary, which is XLY, the American consumer, is not falling at a faster rate. So it's showing you that the economy is actually quite strong underneath. This is a very strange sell-off. Usually speaking, this would already be much lower, and it would already be showing, oh, we think we're going into recession or something. That's not what these yields are doing. These yields are rebalancing for stronger for longer, and therefore we've got like higher yields for longer as well. There's a whole bunch of other things attaching to that and a lot of complex macro, but in discussion, we're not seeing consumer discretionary fall at a faster rate than staples, which is showing the fear is different this time around. S&P 500 is also starting to come down to key levels we'll watch later on today's show, but do remember central bank liquidity is still a decent amount lower, though we might update this on our weekend video to show you another tool that we could be using for central bank liquidity. Let's move over to US oil. It fell. It hasn't gone underneath our important area, which is 78.40. Until that happens, we're not really in a swing trade short, but you can see how it's interacted with this drop, base, drop. It's come back up, found it as resistance, and sold a little bit. I wouldn't be surprised to see oil actually go back to around 82.50 a barrel and then possibly sell from that point. And USO will also come with it at that area. What about the dollar index? Well, it gapped down after it opened back up with all the news that's been coming out. But in general, and that's the futures contract, but in general, it's still in a bull trend. There's no turn yet for the dollar. The US dollar has not been weak. It's been very, very strong for a while here. I would think it's going to become weaker over time. That is a multi-month, year, 2 years away kind of aspect. But at this point, we don't have any weakness. So we're just still looking at a bull trend until proven otherwise. We didn't make a higher high, I guess is something that you could argue over the last 24 hours. So you could mark this low and say, oh, maybe this is a double top. But at this point, we don't know that. And we also have tended to be seeing higher peaks and higher troughs. So again, if we make another higher peak, you've got to stay bullish for longer. Gold's not liking anything to do with these long-term yields. And of course, GDX and gold broke those new lows, moving towards the next level you would think for now. Unfortunate for gold with the news that's come out, but specifically take a look at this downward descending channel. Basically, we've just been going boom, 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 boom the whole way down. If we do make a significant shift off this towards the buy side or the sell side, we're probably moving to the next level. On sells, I could see gold now going potentially to 1850, but we will be looking very closely at the way the weekly closes. So you can see here at the moment, the weekly is quite low down. If this makes a miraculous kind of recovery, then all of a sudden gold could seriously move through. Look for breaks either side of the descending channel. That's going to be a fairly big deal. Tesla continues to do what we've been talking about, which is selling and selling pretty hard. I still think it's coming towards the daily 200, which sits around $200 exactly. It's kind of like an irony there. But at the same time, we've got 210, 200. That's going to be a key level and a fib of the previous pull. It's also going to fill some of these weird little gaps that were left as the market went very, very bullish. So Tesla, it closed on its low. At this point, rallies to be probably still met by sell demand. It's unlikely to stop here just yet. But Apple does show some signs of positivity, even though it's really horrible over the last 24 hours. The only positivity I can get is that in this trade range, this was the most actually traded level, and we saw a little bounce off that level. I'm not going to trade that. I don't think maybe a day trader or scalper would be looking at that type of zone. But for Apple traders to get more interested, we need to break back above this high. We need to see the V start. We don't have any momentum in the bull case at this point, and the chances are that we're probably moving back into that 160, 164 area we discussed before. The biggest stock in the world starting to show weakness, and it's not just there, it's also the best sectors in the world. If it wasn't for Nvidia highly or hotly anticipating the earnings next week, we would say that semiconductors would be a lot lower by now, and they still have many gaps to fill. If Nvidia doesn't live up to expectations, can you imagine what could happen here? Bad things. So do remember, semis are actually moving around. They're looking very weak. They've double topped, as we can see there on the charts. We know big transactions have come through, and if the weekly closes like this, question mark for that for sure. I think this could be partly where we start timing that market, or at least we have a look at it for the end of August, and potentially a little bit of flash selling with maybe a double dip into September. So something that's occurring here. I mean, August is playing exactly the cards that it usually does. Let's move over to Disney. This found absolutely no buying pressure over the last 24 hours. It only was down 0.5, which is better than the market. But in general, Disney's been very disappointing. In this area, we really should have seen a buyer. We haven't yet. There's still chance and time, but yeah, there's just no V. And again, it shows you that even though you might have an area that you think is statistically relevant, which I do, I think that's a pretty important zone, then with, of course, stops below or options or whatever you're looking at, then really when that happens, you can also use final activation steps to really improve your odds. And if you buy the V, you will do better than just buying the dip. So in this case, you might have activated some, who knows what you're doing. Of course, I'm just looking at it from a technical perspective, but yeah, it hasn't found the buyers yet. I'd like to see it break back above this little doji here. So the doji high of 87 plus. And once that happens, I'd say at least maybe Disney is finding some buyers. It's like a 6 out of 10, like we talked about before. CQQQ found some decent buying, considering. I mean, obviously you'd think China, all the news is bad, and it is, but the stock market could actually still go bullish even though the economy is looking bad. It's a property-based thing here, which is a huge part of China, and it's a slowdown. It's going to take a lot of stimulus from the government. So I still don't really change my opinion. I think September into October, there's going to be something here for this market. We don't have it yet, but it still maintains actually at this stage a left shoulder, head, right shoulder style. And we just don't have that catalyst yet from the government and the stim. But yeah, it may be coming, and it may be just around the corner depending on how bad this stuff gets. And it is bad right now. German 40, that's continued to sell off. Of course, we've thought and speculated on this for a little bit. It's sold. This is now a huge area of supply should the market come back, and then it could continue to sell. Remember, 15,400 will be a key level here for the DAX, and it might find some buying pressure, and we'll explain that soon as we go through all of this. Australian 200 stocks for the Aussies out there as we go into the indices of the world, including the S&P 500. We move to this. Well, it's in the middle of nowhere. 7150 is not really interesting. It's not really a buy. It's not really anything in particular. I'd say that sellers are still in control, but maybe Friday brings back up a little. US 2000, also very tough to read. Not much going on here. Very little structure on the lows. The Qs, however, have hit their low point. So they've hit that demand zone. They've actually filled a gap, one of so many left behind. And imagine if the Qs got back down to these levels. Ooh, that would freak people out. But actually, it is kind of possible if we go into one of those flashy, crashy kind of points. Regardless of that, though, we've hit a very key zone. And as we look at the NASDAQ, you can see that it's swiped that low over here, which will have liquidated some people. Now what you might be able to see is a reprieve rally. So if we come back up and we go back above this zone here, we're probably putting in a temporary bottom towards 15,200, which is where the bears sit at this stage for the NASDAQ. And of course, they also sit a little bit higher. So we'll use the S&P 500 in a moment to figure this out. But yeah, the buying yesterday, it started off pre-market, and then it kind of just sold. It was actually looking pretty good in here for a little day trade scalp with stop losses below the low, but it got knocked out pretty fast. Again, risk-reward ratio, you're going against the trend. The current trend is actually down on the 2 hour, the 4 hour, the daily, all these time frames. So we're actually still down. So buying the dip here We have no V, we have no recovery at this stage or anything like that. And I've said that quite a few times. We just don't have the structure. S&P 500, 1, 2, 3. Now, traditionally, it used to be like a known thing that when you see 3 days in a row selling, then you tend to see a buy after that. That's just the kind of theory. We're in Friday here into Opex. We're basically on the new max pain, which we'll look at in a moment. But it doesn't always hold true. But yeah, it was a 1, 2, 3 kind of concept, similar to over here and even arguably over here, actually, because it went sell in the first section. There's another 1, 2, 3. So 1, 2, 3, then sometimes a buy. That is the concept. It closed on its low. It's in the middle of kind of nowhere, sitting at 43.60. That could certainly expose further selling to 43.30, which is the last support low. And you can see here on the futures that we didn't really create enough structure. We now know where our bases are. Bang, one here, bang, one here, and we come back down. If we take that out, similar to the NASDAQ, well, then we could start to think about buying the dip. But there's no structure to say that just yet on things like the 2 hour or anything. Even the 15-minute looks absolutely rubbish. So the problem is it's going to be kind of difficult. You're really going to play the stat of the 3 days down if you're going to do anything, or you're going to basically say, well, we've had so much selling, surely it has to buy. You got to be careful there. And of course, options may be the best method. Remember, 4:30 is where the puts are expiring. So again, max pain actually turned down over the last 24 hours, which shows us that we probably saw a decent amount of calls and a huge amount of closes of options. But 4:30 is the puts. There's calls there. 440 seems to be a topping zone for the next 24 hours. The market would like to stay within this range. We already knew it would stay within a 200-point range this week, but it's pressured into the max pain and actually sits right on it. So it'd be happy just to do nothing and almost create a doji here or some structure. And in some ways, bulls might want it to create structure here. But let's talk about the big one, Bitcoin. Yeah, this thing came out of a coil. Never forget what happened on the S&P 500 this year out of March and April. When we saw that April into May coiling on the S&P 500, which we'll actually go back and have a look at. Let's just do that quickly here. And we go back to the 2 hour. It sat there for a very long period of time. When something sits for a while, when it explodes out, it can become irrational. It's like pent-up demand. Here was a huge coil. There was a massive move. Of course, all shorts had to be realistically removed as we saw those big levels. Bitcoin's kind of similar. Yes, SpaceX news supposedly took it down, but also high yields are not helping it. Let's say the 10, the 20, the 30, they're pressuring gold. They're pressuring, of course, crypto as well and the whole market in general. And we can see this across collectibles and everything else that's speculation. So Bitcoin came through and it just absolutely trashed that most traded level. Again, buying the V is better than buying the dip. That's a little bit of an analogy. Maybe we'll put that on a shirt or something and then we can go through it. If you have ideas for a shirt, I'd love to get one for the conference for Vegas. Then let me know, comments down below. It might be kind of cool. So where did we find the buyers? Right at the low in here. This still could be some kind of bigger switch trend. So be careful here. I am bullish on Bitcoin next year. I'm bullish on it moving forward. Of course, I do like the old halving cycle concept. I just need to see something more from it. And I would like to see it lower before it goes higher. But this would have liquidated everybody. Let's have a look at the small charts. Let's understand how crypto tends to work. And you can see you would have had to have been in early because the market was already selling off. Then it comes back to the most traded level. And then all of a sudden the news comes out and it causes that flash. And what this shows as well is how illiquid Bitcoin can be. And in fact, it's becoming more illiquid as less and less people are trading it at the moment. But that's a huge sell-off. And then the market's rebalanced itself back up to more of a fair value. If it keeps selling, where's the next level for crypto? Well, we'll do a full breakdown on it on the weekend because this is a pretty big, interesting zone. We do know that there was resistances here, support. So, of course, this is a box. But I'd like to see Bitcoin even lower. You know, a 20K handle or something like that would be consistent with what we often see in previous cycle periods before we go into a decent run. So can it keep falling? Well, if August keeps falling for stocks, certainly crypto could. Thanks very much for watching. If you enjoyed today's video, then make sure to, of course, subscribe and smash that like button.